How much power do you really have over your investment? I mean, is it strictly about the percentage of shares you own on paper, or is there something much deeper at play here? Welcome to this explainer. Today, we're decoding the complex and honestly sometimes completely counterintuitive rules of corporate investments. We're going to explore how mere ownership percentages translate into actual, tangible accounting power.
So let's dive right into this. Mastering corporate investments really means understanding two absolute heavyweights in the accounting world, ASC 323 and ASC 810. Now, these aren't just dry, boring regulations. They are the governing laws that dictate exactly how a company presents its financial reality to the world when it buys a piece of another company. I'm super excited to guide you through this and make these complex ideas incredibly accessible.
Here's our quick roadmap for today. We'll cover 1. The ladder of ownership. 2. Mastering the equity method. 3. The consolidation process. 4. Navigating non-controlling interests. And finally, 5. Avoiding common accounting errors.
All right, kicking things off with Section 1, the ladder of ownership. Think of this as your master cheat sheet. US GAAP uses a really specific tiered framework based on your ownership level. Under 20%, that presumes no significant influence, so you use fair value. 20 to 50% presumes significant influence, which triggers the equity method. Crossover 50%, that means control, requiring full consolidation. Oh, and if you're the primary financial beneficiary of a variable interest entity, which is essentially a shell company or special purpose vehicle, you have to consolidate that regardless of your percentage.
But here's an insider secret that trips up so many professionals: the illusion of percentages. Literally every single threshold we just talked about is what's called a rebuttable presumption. What does that actually mean? Well, it means owning 25% means absolutely nothing if you're blocked from the boardroom and denied access to financial information. On the flip side, you could own just 15%, but if you dominate the board of directors, you might still have significant influence. The percentage is just the starting line. The actual power dynamic is the finish line.
Moving right along to our middle rung, Section 2, mastering the equity method.
The absolutely critical phrase here is significant influence. It's the power to participate in financial and policy-making processes. But how do you actually prove that? You look for the indicators. Are you sitting on the investee's board of directors? Are there massive, material intercompany transactions happening? Is there an interchange of key managers or essential tech information? If you answer yes to these, the equity method is required, even if you don't hit that strict 20% mark.
Okay, so you acquire the investment and you record it at cost. Sounds simple enough, right? But here is where the hidden mechanics kick in. When your purchase price exceeds your proportionate share of the investee's net assets at fair value, you create investor-level goodwill. The crucial thing to remember here is that this goodwill is embedded directly within the investment in affiliate account. It is never amortized as a separate asset, and it's not even presented separately on the balance sheet. It is totally invisible, but it is definitely there.
Once you've initially recognized that investment, 3 specific events drive its subsequent measurement. You can think of this as the rule of threes. First, your share of the investee's net income increases your investment account. Makes sense, right? You own a piece of them, so as they grow, your investment grows. Second, dividends received actually decrease the account. And third, your share of the investee's other comprehensive income, or OCI, which are basically unrealized gains and losses not yet on the income statement, is mirrored proportionally in your own books.
Let's actually pause right here for a second and really absorb this. Dividends are a return of capital, not income. This is, without a doubt, the most commonly misunderstood feature of the equity method. When you receive a dividend check under the equity method, you do not credit revenue. No way. Why? Because you already recognize that income when the investee earned it back in step 1. The dividend is literally just the investee handing you some of the cash value that you've already claimed. Therefore, cashing that check simply reduces your investment account balance.
And this brilliantly illustrates another major complexity: intercompany transactions. Whether you're dealing with downstream sales where you, the investor, sell to the investee, or upstream sales where the investee sells to you, the rule is exactly the same. You must eliminate your percentage share of any unrealized profit. You simply cannot recognize profit by selling things to yourself. That profit is only recognized when the asset is finally sold off to an outside third party.
All right, climbing to the very top. Section 3, the consolidation process. We are now governed by ASC 810. Consolidation is strictly required when a parent has a controlling financial interest. Generally speaking, that hard line is crossed the moment you own more than 50% of the voting shares. When you hit this threshold,
everything changes. You don't just record an investment account anymore, you absorb their entire financial reality into your own. Step 1 is an absolute game changer. You combine the financial statements 100%. Even if you only own 60%, you are bringing over 100% of their assets, liabilities, revenues, and expenses. There's no prorating here, it's all or nothing. Next, you got to clean house by eliminating all intercompany revenues, expenses, balances, and unrealized profits. Then, you eliminate your investment account against the subsidiary's equity, because obviously you can't own an investment in yourself. Finally, you recognize the non-controlling interest.
Which brings us perfectly to Section 4, Navigating Non-Controlling Interests.
Think about it. If you consolidated 100% of a subsidiary, but you only actually own 80% of it, what on earth do you do with the 20% that belongs to someone else? Well, you create a non-controlling interest, or NCI. And I really want you to burn this into your memory. Non-controlling interest is permanent equity. It is absolutely not a liability. It doesn't go in the mezzanine section either. Under ASC 810, NCI is presented as a separate line right within stockholders' equity. On the income statement, you show the total consolidated net income, and then you just split it to show the portion attributable to the parent and the portion attributable to the NCI.
Now, when you establish that NCI at the date of acquisition, you actually have a choice in how to measure it. The full goodwill method measures NCI at full fair value, which means both the parent and the NCI share in the goodwill. But US GAAP allows a specific election, the partial goodwill method. Under partial goodwill, NCI is measured at its percentage of identifiable net assets only, meaning the goodwill is attributable to the parent only. Just remember, this partial goodwill method is uniquely a US GAAP election, and you decide it acquisition by acquisition.
Let's wrap this up with our ultimate survival guide. Section 5, Avoiding Common Accounting Errors.
First, let's briefly review the mechanics. For an equity method income accrual, you increase your investment account and record equity and earnings. When you finally get that dividend check, cash goes up, but remember, the investment account must go down. And during consolidation, you've got to allocate a portion of the net income directly to the NCI equity account to properly account for those minority owners.
And here are the literal fatal errors you must avoid. We've hit a few already, but let's recap. Never treat equity method dividends as income. Never consolidate only your owned percentage. You must consolidate 100%. Never classify NCI as a liability. But also, consider a partial sale while you still retain control. Let's say you own 80% and sell 10%, dropping to 70%. You still have control. That is strictly an equity transaction. You adjust additional paid-in capital, not earnings. Absolutely no gain or loss hits the income statement there.
But that leads us to a really critical, thought-provoking question to ponder. What happens if tomorrow your 60% control suddenly drops to 40%? Well, you just lost control. One single percentage point drop can fundamentally trigger a massive deconsolidation event, completely rewriting your entire balance sheet and forcing you to calculate gains, losses, and translation adjustments from scratch. The ladder of control is rigid, but man, the climb is absolutely fascinating. So how prepared are you for a sudden drop? Thanks for joining me on this explainer. Keep this framework in your back pocket, and you'll navigate corporate investments like a true master.